we need is, okay, what do we need? First of all, you should read that. Which one of the, to determine the operating cycle, you need operating cycle is equal to, don't jump into that, you should read the questions correctly. Operating cycle is equal to inventory turnover days, so inventory holding period, or inventory turnover in days plus receivable collection period or receivable turnover days. These are the two things you require. So day sales in account receivable, so you have that, and average merchandise inventory only. So average merchandise inventory will not give you holding period, right? So you need then, what do you need actually? You need the sales. So in the numerator, so that is not there. So this will not help you to find. You need additional information. Cash turnover and net sales, that is not going to help you at all. Account receivable turnover days and inventory turnover days, that is what is needed. Account receivable turnover and account inventory turnover. Even if you don't have the turnover days also, it is fine, because 365 divided by account receivable turnover would be the account receivable turnover days. 364 divided by inventory turnover would be inventory turnover days. So 365 is the number of days in the year, so that you already know. So if you have this information, you can always compute the operating cycle. Asset turnover and return on sales, if you have it, you will not be able to find the operating cycle, right? That's not good enough. Asset turnover is turnover divided by average asset. Return on sales is net profit divided by sales. What do you have actually, like if you have the asset turnover is turnover divided by assets, and return on sales is net profit divided by turnover. So what do you have when you have these two? You have ROA, right? So when you are having these two ratios, you are getting return on asset. But here the question is for finding the operating cycle. So this is wrong. Next, question number 14. That's the last question. Just do that. Then we will have a discussion on the last subunit of this section, and then we will do one or two some questions, and then it will be over. Okay, Sami got B as the answer. Subin also has got B. Let's do this. A company has 3 million per year in credit sales. What's the question? Assuming 360-day year, what is the company's average amount of account receivable outstanding? That's the question. company's average days sales outstanding is 40 days. So company has got 3 million in credit sales and average days sales outstanding is 40 days. So average days sales outstanding is equal to 365, no, you are saying 360 divided by account receivable turnover, right? This is one formula we have learned. So this is given us 40 days. So you can find out the account receivable turnover, and that's, you can do that way, like or what is there a better way to do this? So the company uses 3 million per year in credit sales. Company has 3 million per year in credit sales. The company's average days sales outstanding is 40 days. Assuming 360 days, what is the average amount of account receivable? You don't have to really go by all these formulas, all that. If you understand the concept, you have the 40 days outstanding in the receivables. So how much is the average receivable outstanding? So you can just immediately with the given, if you really know the concept, it is average receivables is what we ask. That is 40 days sales. And you are given that you are given that for 360 days it is 3 million sales, right? So 40 days sales is how much? 40 days sales, right? So 3 million is the sales for 360 days. So for per day, what, how much is the sales? Into 40 would be the average sales. How much it will be? Take that 3 million, 3000 divided by 360, that is 8.333 into 40, it is 333, 333. So B is the right answer. So Sami got the answer, but others can really get it. This is just the understanding, the true understanding of what is average receivable, right? How many days sales outstanding? You are given 3 million sales, you are supposed to assume 360 days year. So that means average daily sales is 3 million divided by 360. Such sales is outstanding for 40 days. So into 40 days is the average this year. So the next subunit is just a theory, right? I have been really discussing about ratio analysis. So let's do the questions, because there's nothing like I can use that subunit as a wrap up. So let's finish up these questions, and probably while discussing also I can really give you an insight about what is the content of the last subunit. I don't think you will be better off after I finish off the discussion to do these multiple choice questions. So better do the multiple choice questions. There are only 4 questions. Let's finish that off and then use the remaining time effectively for the discussion and the wrap up of this study section. Here's a big scenario, so don't waste your time. You know that there is a table giving the company and competitor and some ratios. You have already learned all the ratios. On the basis of this information, which one of the following is best initial strategy for the, like prima facie strategy, best initial strategy for the CFO to follow in attempting to improve the flexibility of the company? So the CFO wants to really look at this ratio, company versus competitor, and then what is the best initial strategy just based on this information, right? When you go into that, you may see that what you are concluding may be wrong, but just based on the information given, what is the initial strategy for the CFO to follow in attempting to improve the flexibility of the company, right? There are some ratios, and if you want, you can really read. You don't have to really look at the ratios now, because each ratio has got so much analysis behind it. So you just don't look at that ratio now, but instead read this scenario. There may be some very pertinent information given there. A CFO has been tracking the activities of the company's nearest competitor for several years, right? Among other trends, CFO has noticed that this competitor is able to take advantage of new technology and bring new products to market more quickly than CFO's company. So that means their marketing team is really vigilant, and they are really bringing the new products so fast, taking advantage of the new technology. That's what they are doing, right? So they are faster in innovation. They are faster in bringing the new technology to the customers and grab that sales. In order to determine the reason for this, CFO has been reviewing the following data. So you are given some ratio, right? So now read the question and whether that is consistent with read the choices and whether that is consistent with the CFO's objective to give an initial strategy to follow in attempting to improve the flexibility. Just go through each of the choices and then give your answer there in the class conversation. Okay, Kevin got C. So please stop doing it. Listen to me. Seek cost cutting measures that would increase the company's profitability. First of all, look at the profitability ratios here. You have return on asset. You are 15.34 compared to competitor 14.74. So you don't have an issue with profitability. So when you are having a very comfortable profitability, when you still go for cost cutting measures, then your operational flexibility will come down, not improve. So you don't have a real need to really improve the profitability because you're already better than your competitor. Return on asset is a very good profitability measure. And you should also understand that when you are really go for when you really go for cost cutting, that will really affect your flexibility, right? Operational flexibility, I think. So this is not correct. Investigate ways to improve the asset efficiency and the turnover times to improve liquidity. So do they have a liquidity problem? Their current ratio is 2.11 against the competitors, much better liquidity. So you don't have a liquidity problem. So this is, you don't have to really waste your time and energy to improve the asset efficiency and turnover times. Asset efficiency also, let's see that. Asset efficiency will come account receivable turnover ratio, that is an asset efficiency, but it's only one portion of it. There we are little lacking. Then but the main thing is actually turnover. What is it? Investigate ways to improve asset efficiency and turnover times. Turnover times. Where is the turnover? Account receivable turnover, right? Investigate ways to improve asset efficiency and turnover times to improve liquidity. Yeah, to improve liquidity, that is the whole thing actually. Like you don't have a liquidity problem, so you don't have to really try to improve liquidity. That is, so stop with that. Don't waste your time. Seek additional sources of outside financing for new product introductions. seek additional sources of seek additional source of outside financing for new product introductions. Probably it may be true that you don't have enough funds. So if you are comfortable, you can go for additional financing from outside sources. But let's look at the ratios. Account receivable turnover will not give you anything about your debt capacity. Return on assets will not give you even, like, you can go for loan when you are profitable, you are very profitable. Times interest earned, that is a very pertinent issue. Your EBIT level is very comfortable compared to your competitor, so you can go for debt. That will be sufficient to cover your fixed charges. So times interest earned is a really high ratio, so you can go for additional sources to fund the new product introduction, because the competitor is coming up with the new products, new technology, and you are lacking maybe because of funds. So you have the capacity to go for this thing because your times interest earned ratio is favorable to you. Current ratio is liquidity, there you don't have a problem. Then debt equity ratio, yeah, your debt component in the capital structure is only 42%, whereas 56% is the competitor. So that means you are comfortable there to take more debt load also. So that is also really favorable to you, that you can increase your debt component in the capital structure. Degree of financial leverage is 1.06. That means a low degree of financial leverage, so you can leverage further, you can go for further loan, so that is also on your advantage. So you can go for more debt, you can go for additional source of outside financing and compete in the market by bringing the new products. So this is correct. So Rahna, Kevin got answer correct. Increase the company's investment in short-term securities to increase the current ratio. Already you are too high. Why do you want to really increase that? So that is not correct. Not too high compared to the competitor. You are in a much comfortable position. That's all. So C is the only answer. Next. Again, you are having a table with SRH and industry average. Based on the information above, select the strategy that should be the most beneficial to the bank. That should be the most beneficial to the bank. A bank has received loan applications from 3 companies, right, in the plastic manufacturing business. So all the 3 companies are in the same industry and currently has the funds to grant only one. So there is a competition. That is always the case actually. Like, you cannot cater to all the eligible applicants. So you have to select the best and then give the loan, right? So here you have 3 applications and you have to select the best from the lender's perspective, right? Lender will look for low debt equity ratio, lender will look for low financial leverage, lender will look for high interest coverage ratio, debt service coverage ratio, right? Those are the things that lender will look for, right? Specific data shown below has been selected from these applications for review and comparison with industry average. So let's go for this. You have these things, so don't waste your time. So let's read the choices and give your answer in the class conversation. Okay, Kevin and Sami got C as the answer. So let's read that. Based on the information above, select the strategy that should be the most suitable for the lender. The bank should not grant any loans as none of these companies represent a good credit risk. I think the foremost indicator of credit risk is debt equity ratio and financial leverage. Here it is 1.33 industry average and 1. See, there are some companies above and there are some companies below. So based on financial leverage, definitely some would qualify because some are above, some are below. So whatever is it actually. Then debt equity ratio 48 point this thing, So at least one company is having less debt than the industry average. So if this industry can be given any loan, you have all the candidates, all types of candidates. So this is, without wasting your time, you can say that you have some candidates which could be a good credit risk compared to industry average. So this is wrong. Then grant loan to yes, as all the companies that approximate the industry average. This per se is wrong, because you are not trying to give loan to an average company, you are trying to give the loan to the best company, right? Not to the average, right? You are going to give loan to companies which are better than the average. So approximating industry average is not really a good thing as such. So you can really say that it is not really correct, right? Provided some other companies are less than the average, then yes. But then you have seen that at least the parameters we have already discussed, some companies are better than the industry average. So you are not going for any company which is same as the industry average. You're going to choose the company which is better than the average. So that's all. Then grant loan to R as both the debt equity ratio and degree of financial leverage are below the industry average. Those two indicators, the less it is, the less risky, you are more comfortable. So that is the reason Sami and Kevin gave that as the best answer. So this two things like financial leverage and debt equity ratio are below the industry average, means actually you can give them more debt load, there is no issue. But other parameters are also applicable, so you can really look at that whether it is correct or not. Financial leverage for R is 1.02, whereas that is the least, and whereas the industry average is 1.33. So it is better than industry average. You are getting a company which is less financially leveraged than the industry average. That's a good bet to go for new loans. Then industry average debt proportion is 48.3. R is having only 44.6. That's the least among them. Those are very pertinent ratios. There is no doubt that this is correct, right? C is the answer. But what is the other pertinent ratio? Times interest earned. Is it given? No, it is not given. So based on the given information, then you are very comfortable giving loan to R. Then grant loan to H, as the company has highest net profit margin. That's a good thing. If the company is having good profitability, it's a good company to give loan. But highest degree of financial leverage is on the opposite side. You should give the loan to the company with the lowest financial leverage. That's a company which should really have less creditors. So this is wrong. The highest degree of financial leverage is inconsistent with your objective. So this is wrong. C is the only right answer. Next question. Question number 17. The key difference between accounting profit and economic profit. So here I will, in the discussion, I will talk to you about that actually. See, the ratios are computed from the financial information, right? GAAP compliant financial statement is giving you the accounting profit, which is different from the economic profit. Why is it so? Because interest is the reward for the debt capital that is coming there in the income statement, whereas the reward for equity is dividend. That's not there in the financial statement, in the GAAP compliant financial statement, right? So what you get from the published income statement is not the economic profit, that is only the accounting profit, right? So you have to really go for an imputed capital charge if you want a true economic surplus. Okay, so you have to consider the opportunity cost of equity if you want the true economic profit. So the key difference between accounting profit and economic profit is the fact that the accounting profit does not consider the reward for equity, cost of equity, dividend is not considered in the accounting profit. That's a key difference. The economic profit should consider the opportunity cost of capital, and then only you can really find out the true economic surplus. So it considers the key difference between the accounting profit and economic profit is that the economic profit considers the opportunity cost of capital, whereas the accounting profit ignores the opportunity cost of capital because dividend is not an allowable expense. Highlight the historical cost concept. That's not a key difference between accounting profit and economic profit. I mean, then calculates changes in supply using EOQ model. That's really an efficiency management method. Calculate changes in supply using EOQ model. It's not really going to be any, make any difference to the economic profit and accounting profit discussion. So this is wrong. Excludes income tax and interest expense. It includes income tax and interest expense in both the aspects, right? Accounting profit also considers interest. Accounting profit also consider income tax. These are two expenses. Even in economic profit also you will consider. So that is not differentiating factor. So consider the opportunity cost of equity is the answer. But we will have that discussion in the last subunit. Then which one of the following actions undertaken by the technology company's management, which one of the following actions undertaken by a technology company's management will adversely impact the quality of its earnings, right? So which of the following actions taken by the management will adversely impact the quality of earnings? So there is a discussion I am going to have about the quality of earning. Let me do that now. What is quality of earning? The quality of earning is the quality that the earnings is predictable. What the forecast would is very McDonald's food is having better quality than what does that mean? McDonald's food is having better quality than home food. Because quality is a statistical terminology. It has got nothing to do with the nutritional value. It has got nothing to do with the taste. Right? It is that the McDonald's food will taste the same every day. Whether that is a positive thing or negative thing, you should really think by yourself. But quality means consistency. Like if a production process is having quality, means if you are manufacturing a 2-inch screw, the screw would be like 1.99 inches or 2.01 inches, right? It should be within that tolerance limit. Then the product, then there is a statistical quality control, you can say, right? Going say 1.95, it will not suit your purpose. 2.05 also will not suit your purpose. Right? This is what is same thing can be right within the tolerance limit in and around the standard. That is what is right? You understand? So that is the case I said actually. Going to McDonald's, you will see that every day the burger tastes the same, coffee tastes the same. Why? Because they put the fire on the same flame, right? And then they fill the barrel with the same marker, and then they will take the coffee powder measured and the same brand. So if you go every day, you will get the same quality. Burger will not be overburned or anything of that sort. But whereas at home, we don't do that kind of precision as such. So one day it may be at the low flame, and another day it may be at high flame. And one day you will be using one coffee powder, another day you will be using another coffee powder. So the coffee will taste naturally differently from this thing. So there will be less quality. Less quality is more variability in the outcome, right? So which one of the following actions undertaken by technology companies management will adversely impact the quality of its earnings? Using conservative, okay. So, but I told you, when you are trying to manufacture 2-inch screw, you are having a 1.99 or 1.95 inch screw also will not suit your purpose, and 2.05 also will not suit your purpose, right? So you have to really have within the, say, plus or minus 0.01 difference this thing, then only that mechanical process is under control, then only you can say that you are really maintaining the quality. But when it comes to finance, right, you are not worried about the downside risk. I mean, you are not worried about the upside potential. Like when you say somebody from the historical financial statement, somebody make a forecast that the next year you will have a 1 million profit. If the company makes 1.5 million profit, people all will be happy, and then nobody is going to say that the analyst who said that 1 million profit is wrong. Because 1.5 million is considered an upside potential, he is not considered wrong. It's not like a mechanical process. So the quality of earning means actually the more he is conservative, the more the profit is conservatively arrayed, the more confident that the more confident the reader that the future year profit would be at least above that. Right? So the more conservative you are, the quality of earnings like that you should really understand, right? So using conservative estimates for the useful life of the company's equipment. If you are having conservative estimate means actually you are not underestimating the useful life means. Right, then you are having not this thing. You are it's opposite actually. Like when you are having conservative estimate of the useful life of the company's equipment, that you are thinking that the asset will last only for few years. You are taking more depreciation, right? So that be the case actually. Your the more conservative you are, the better it is. That is not going to adversely affect. That is going to improve the quality of earning, right? So this is like the more conservative you are in your historical computation, the better would be the quality of earnings. What is meant by quality of earnings? The future earnings projected based on the historical information would be better than what you are projecting. So if you are having very conservative policies, you will have low profit. So that means your actual would turn out to be better than what you projected. So this is not going to adversely impact. The more conservative, then you are really having more upside potential. Upside potential is not considered a risk, and it is a good thing. So using conservative estimates is always better. That will improve the quality. Recording sales of software prior to installation and acceptance by customers. That is actually you are really exaggerating sales, right? See, sales should be recognized only after the installation is complete and the customer is listening. So that means there is a tendency to overestimate sales. There could be a reversal of what you have done as such in the subsequent period, what you have recognized. So that can really bring down the future profit. That can adversely impact the quality of earnings. So this is correct. This can adversely impact. Recording sales before the installation done and acceptance by the customers. This is like exaggerating sales, right? Overestimating sales, not becoming conservative. It's opposite. That can really bring down the quality of earnings. Then immediately expensing the product research and development. If you are expensing anything early, that means the historical profit is the least, right? So you are very conservative then. So the future profit would be better than your projection based on the historical. So this is also like
എല്ലാരും ചെയ്യും.
positively impacting
എല്ലാരും
quality
ചെയ്യും, പക്ഷെ ചിലവന്മാർ
of
ചെയ്യത്തില്ല.
earnings. Then estimating low rate of
നല്ല
return on the
ഡോക്ടർമാർ
company's
ചെയ്യും.
pension plan asset. When you are assuming low rate of return, you are becoming very
അപ്പൊ
conservative.
അതിനാ
Your actual would turn out to be better than what you projected. So that is going to really going to be advantageous. That is going to improve the quality of earning when you are conservative. So this is also not correct. So B is the only thing which is going against that as such. So which can adversely affect the quality of earnings. So we have finished the multiple choice question. We have half an hour. So I will just quickly go through the last subunit, and we have only 25 minutes left. No, 30 minutes. We say 28:25. So let's go through that in the order. Ratio analysis is an important tool for analyzing the firm's financial performance, right? So that we have already seen. Ratios is a very important tool in analyzing firm's financial statement. When you say that the company's advertisement expenditure is this much, you will not have a clue. But once you relate that to the sales or any other number, then you can compare one company with the other, right? So then it is more meaningful. Actually, you are turning the absolute numbers into some usable information where you can really understand what is happening. So ratios are very useful in analyzing the firm's financial performance. But you should have some comparison, some benchmark, right? That benchmark can be the previous year. If you are really having your own historical information, you can really see whether you are improving or deteriorating. So your own past performance is a good indicator for really seeing whether you are improving or not. See, return on investment. How much was it in the last year, and how much was in the year before last year? So if you take a trend, whether you are improving or not. So your own past performance is a good benchmark to really see whether you are improving or coming down. And then you can compare that with the aggregate economy. Say, for example, return on asset is say 15%. So that means you are getting a 15% return on the capital employed. In an economy where you are getting only 7% if you deposit money in the bank, or 10% if you are depositing that in a corporate deposit, getting from your investment some 15% compared to the aggregate economy is a really good profitability. Like that, you can compare the ratios you're computing with the aggregate economy, right? And then you can compare that with the industry average. That is a better indication for the performance of the company. So you can, but somehow you have to have some benchmark, otherwise the ratio analysis may not really give you good insights. That ideally should come from the industry average, right? But you may not be you may not be really having information regarding the industry average, but you should look for that. But there you should understand that actually the industry averages are useful only for companies engaged in one type of business. Like, but when you are a conglomerate, what is meant by conglomerate? The company is engaged in more than one industry, right? So there, the blanket profitability ratios will not be suitable for comparison as such. So you have to really overcome that certain key information in a published financial. You need segmented information, but that is limited. But still, you can use that. You should never use the mistake of comparing your ratio with industry which is not relevant to you, and that issue is really serious. You will not be having a comparable industry when you are a conglomerate. You should really know that. So ratios are meaningful only when you are compare that with the benchmark. That benchmark can come from aggregate economy or industry average, or if nothing available, your own past performance. That is always available, right? So your own past performance is a good benchmark, right? Then ratio analysis can be used to analyze financial statements. That is what we have just discussed. Judge efficiency. If your GP ratio is 20% and the industry average is say 30%, then there could be some improvement as such needed. So you can really see the efficiency, right? So if you're comparing this year versus previous year, you can really compare the efficiency of the management, the performance, right? You can compare the performance, you can get the efficiency, and you can really, once you see that your GP ratio is low, then you can really see whether that is coming from material or labor or overhead, and then you can identify that. If it is material, then is it volume variance or rate variance? All that you can really go into that, but the starting point is the ratio analysis, right? To judge the efficiency and to locate the weakness. And you can use these ratios to formulate plans. So like if you want in 10 minutes a first cut budget, you can do that, provided you have the previous year financial statement in the common size format, right? If you have it in the common size format, you just need, okay, there is a 10% increase in sales, so you know the next year sales, so you have all the income statement as a percentage of sales you have, so you have a first cut budget ready. So this ratio analysis and the common size statements are very good tools to formulate plans, right? So you can even set the objectives in the plan, like I current year GP is this much, but the competitors are having this much GP, so I need to improve that. So let's take a target GP and then work towards that. So you can really compute that, you can formulate the plan, and then you can track the actual performance against the plan. So all that can be done, and you can identify the like when you see GP is low, where is the issue? Is it in the material, labor, overhead? Similarly, NP ratio, like is it in the operating expenses you're having a problem? Are you spending too much on headquarters expense? Are you spending too much on the training or too less on the training? Are you spending too less on the R&D? All those things you can really see, and then you can identify the weak areas for improvement, right? Then you can track the performance once you have the target. Like I want to improve the net profit margin from the current 15% to 20%. So you can every 6 months you can really see whether that is happening or not. You should really move in the right direction at least. So you can really see that and then track performance. And then ratio analysis provided tools to determine how well a firm is performing over the years compared to other similar firms. Then ratio analysis is subject to inherent limitations that can affect its usefulness. That is what you should really understand, right? What are the inherent limitations? One is that the ratio is computed from the published financial statement, which is giving you accounting profit, which can be different from the economic profit. What is the difference between economic profit and accounting profit? Accounting profit is computed as per GAAP, and their dividend is not an allowable expenditure. Dividend is a reward for capital, but then that is not allowed to be taken as an expense. So to that extent, you have to compute an opportunity cost of capital, the imputed cost of capital. Then only you will be finding the true economic profit. So that's an inherent limitation of the accounting data, and ratio analysis suffer from that. So you need to find other ways to really find the imputed capital and then use that. So that will not come from the accounting data. So you will not have that kind of information from the accounting data. So purely based on accounting information, ratio analysis will suffer from all the limitations of the accounting profit. That's it. And then another issue with the accounting profit is that the management will always try to manipulate. There is an incentive to manipulate the financial information. Like if you're worried about the income tax, then you will try to understate the profitability so that you pay less tax. So the ratios computed based on that will not be correct. Similarly, if you are a public company, the management's single most objective would be to maximize the shareholders' value, right? So that means to maximize the market capitalization. What is market capitalization? The number of shares into market price per share. Right, when the prospects of the company is really bright, then only the market will value the company in the right, favorably, right? So you should have high accounting profit. So you will understate all the expenses. You will try to exaggerate the income. That's the nature of the accounting profit. So if people are trying to window dress the financial statement, window dress means trying to give a rosier picture than the actuality, then the ratios also would be affected. It will not really give you the correct information, right? So the common areas for the accounting profit to be wrong is they will try to overstate the sales, right? So you have to really see whether they have followed the correct cutoff, whether the goods are delivered, all the risk and rewards are transferred from the seller to the buyer. All those things are there. So, but still, the companies can really go for manipulating because there is actually a good correlation between the accounting profit and the share price performance. That's not the only thing which can really affect, but then that is one of the most important input as far as the share price performance is concerned. If you go for fundamental analysis, the company is more profitable, then the share price would be higher, right? So there is a motivation to overstate the profit. And I wanted to say something, I forgot.